A scenario every trader knows. You buy the dip, watch price drop through your stop loss, and then it rockets upward without you. Financial markets don't move in straight lines. After a strong push, they breathe. Traders take profits, causing a pullback, while new buyers look for a place to step in. This chart shows the standard tool most intermediate traders use to catch those pullbacks, the Fibonacci retracement. It maps out potential support levels based on a mathematical sequence. But plotting these basic lines doesn't actually give you an edge. Millions of market participants are staring at the exact same arbitrary levels, creating a lot of noise and false signals. To survive these retracements, you have to filter out that noise. You need to locate a highly specific hidden magnet for price action, known as the golden pocket. The power of this specific trading zone originates from phi, or the golden ratio. It's roughly 1.618, a mathematical constant governing equilibrium and natural growth, visible in the expanding spiral of this nautilus shell. This ratio is deeply ingrained in the human perception of balance. Builders have relied on it for thousands of years to proportion enduring architecture. When we map this natural equilibrium onto financial markets, we find the exact psychological threshold where profit-taking exhausts itself, and new buyers decide an asset is officially a bargain. The golden pocket is driven by predictable human behavior. It's a deep enough pullback to shake out nervous retail traders, making it an ideal liquidity pool for institutional algorithms to fill their orders. To actually use this tool, you have to follow a strict rule. Only look at clear, dominant market trends. If a market is choppy or moving sideways, skip it entirely. Next, locate the significant swing highs and swing lows. These are the absolute, undeniable peaks and valleys of a major price move. Ignore the minor wiggles in between. Anchor your tool at the swing low and stretch it to the swing high. The golden pocket sits strictly between the 0.618 and 0.65 levels. A price drop into this box clears out sellers, allowing algorithms to resume the primary trend. By defining this exact mathematical zone, you turn what looks like a chaotic, terrifying market drop into a targeted, predictable entry point. But buying simply because the price touched that box is a rookie mistake. You have to wait for confluence, which is when multiple independent indicators all agree on the exact same signal. For our first layer of confluence, check if your golden pocket aligns with a horizontal historical support zone. Next, a 50-period moving average sweeps up to intersect that exact zone. Finally, wait for a bullish engulfing candle to close entirely inside the pocket. When you stack these independent indicators together, you drastically multiply your statistical edge. A theoretical bounce becomes a highly probable, actionable signal. Even the most mathematically perfect entry will fail against market anomalies. Strict risk management is required to protect your capital. This chart shows how the golden pocket's precision dictates your defense. Place a tight stop loss, an automatic order limiting your risk, just below the foundational swing low. Your take-profit target is mathematically structured, so the potential reward is at least double your risk on every trade. Be aware of the environment. Major macroeconomic news events or sudden high volatility spikes can effortlessly shatter these mathematical levels. Because of those variables, backtesting this framework against historical chart data is a mandatory step before you ever risk live capital. Mastering the golden pocket shifts your trading from reactive guessing to executing a surgical, professional strategy. You can test this exact framework today using the advanced charting tools on your free FXNX demo account.